If there's one thing that people understand about pensions in the UK, it's their tax-free cash. That beautiful 25% slice that HMRC just cannot get their hands on. The lump sum, the lumper as it's affectionately known in these parts. People get that element. I speak with a lot of people about pensions and they might not get all of the intricacies, all of the rules, but they certainly know that they've got their 25% tax-free cash entitlement. So surely any government that cared about their approval ratings or cared about encouraging people to save for their retirements, well, they wouldn't mess with this well understood and well loved feature of pensions, right? Well, they haven't ruled it out. And I don't blame the media here, let's face it, their job is simple: get clicks, sell advertising. So they write stories because when you leave a gap, speculation fills it. We eat these stories up, they print them, the cycle goes on. Hey, I'm on this platform right now talking about this, but hopefully it's from a rational standpoint to try and answer the question at hand. Because with a supposed £20 billion gap to fill, it seems that nothing is off the table. Well, other than all the taxes the government already boxed themselves out of changing. But I'd imagine if Rachel Reeves and her team are sat down, that pensions are going to be one of those options on the table, one of the targets that they're looking at to try and raise more revenue and balance the books. And this frustrating speculation has led to tons of people taking money out of their pensions that I'm going to guess they wouldn't have taken if this fear and speculation hadn't stirred up and been in their face. But look, I'm going to try not to rant, wish me luck with that, and just simply answer the question as best I can. Should you take the tax-free cash from your pension before the upcoming, albeit delayed, November budget? Let's get into it. Hi, I'm Andrew, Chartered Financial Planner based in the UK. If you're new here and you like this type of content, you know what to do. Tap that subscribe button for plenty more to come in future. Right, before we jump into things, let's just have a very quick recap on the basics so that we're all on the same page. To access anything from your pensions, you'll need to be at that statutory minimum age, currently age 55, unless you've got any protections or serious ill health, unable to work type situations. So if you don't meet that criteria, don't worry about any of this. You can't access your tax-free cash in any event. Assuming that you can get access to your pensions now, the type of pension that you have will broadly fall into one of two camps. You've either got a defined benefit scheme or a defined contribution scheme. Starting with defined benefit, often referred to as final salary or career average schemes, when you take your tax-free cash lump sum from that scheme, you will start the payments of income as well, so those regular monthly income payments. So already you can start to think, well, do I actually want that? And what if you're active in the scheme now, it's your workplace pension, you're still building benefits up. Do I want to take that and then have to sort of re-enter the scheme? There's lots of complications with the DB side that make it not straightforward. If you have a defined contribution pension, often referred to as money purchase, these are your personal pensions, your SIPs, then it's relatively straightforward, but you do have options to consider when you take money out of your pension. There's three key routes. Either you are fully cashing this in a lump sum format with 25% coming to you tax-free, but the other 75% being treated as income in the year that you receive that. Or you go the second route, take your tax-free cash perhaps, and then send the remainder to an annuity company, an insurance company who guarantee you income for the rest of your life, or perhaps a fixed term. And I've covered that in other videos if you want to check out fixed term annuities. Lastly, the most popular option as it stands now, income drawdown, where you can take your tax-free cash and leave the remainder invested. You can take income, but you don't have to. And under current rules, you can take a maximum of £268,275 under the lump sum allowance. This is a lifetime allowance, so it's how much tax-free cash you've had from all of your pensions during your lifetime. Okay, so with a clear understanding of the rules, before we go taking any money out of pensions, I would ask myself these questions, starting with, do I need the money? Why am I taking the tax-free cash and where is it going? What purpose does it have? Am I taking it to pay off the mortgage balance or clear other debts as I go into retirement? Am I taking it to gift it to a family member, a son, daughter, or help them with some university fees? Am I just going to use it for a new car or some home improvements? As long as that's part of your plan, as part of your financial planning, well, what's stopping you? I've got nothing against people taking money when they need to take it. But if we are taking it with no purpose, no plan, and it's just out of fear that's been prompted by speculation, well, of course I'm going to err and caution against doing that. Secondly, building on that first question, if I do take this money, where does it leave me? Am I still okay for the future? Particularly if I take this money and I spend it or I give it away, does that leave me with enough still? If you're unsure about that, part of the job we do as financial planners is help putting your mind at ease there. We use cash flow modelling tools to project into your future, looking at all of your pensions, your income, your assets, and saying, do you have enough? Will you always have enough? Are you going to be okay? That's the most fundamental question of any financial planning. So if you're doing this yourself, you are going to need to do a little bit of forecasting and work out, if I take this money, and even if it sits in a bank account and then you unintentionally spend it because it's kind of there and burning a hole, where would that leave you? Are you still okay? The third question to ask is about the tax consequences after you've taken the money. Yes, it's tax-free as you take that cash out, but what happens next? If you're not going to spend it or gift it, where will you hold it and what are the tax implications of that? If you're sitting in a savings account outside of an ISA, yes, you might get some interest, but would you pay tax on that if you went over your personal savings allowance? Could you use a partner's or spouse's allowance to help with that? Can you use your ISA allowance to shelter money if you're going to keep it? Again, between a couple, that might be £40,000 that you can shelter this tax year. But what if you've got money over and above that? What if it's a large lump sum? What if you invest that money in property or stocks and shares and it makes money? You might have income tax or potentially capital gains taxes to consider. I'm not saying this is wrong, but it's just something to weigh up before you go taking money from your pension. What are the tax consequences after? And on the point of taxation, a couple of other things to consider, particularly relevant to pensions. Firstly, if you take any taxable income flexibly from a pension under an UF plus payment or drawdown income, you'll have then triggered the money purchase allowance, which limits future contributions to £10,000 a year. So if you're still working in your mid-50s maybe with high earnings, just be wary that you don't cause yourself problems for building up future pension money just by, say, cashing in a smaller pension plan and doing an UF plus payment that then causes you problems. And my second point on this is, right now as we stand, pensions sit outside of your estate for inheritance tax. So they're really tax efficient to pass on money on death, particularly if you're under age 75. If you bring money out of the nice pension wrapper and put it in your bank account, or even if you gift it, this will impact your estate. And that might mean that you have inheritance tax, maybe a liability up to 40% on that tax-free cash. I know pensions are due to come into IHT from 2027, but we've still got this window here. So it's another thing to think about before you draw money out of your pension. Okay, so I've given you the questions, the things, the planning points that you want to be looking at before you go and take your tax-free cash. But I know you want more than that. You want to know what I'm thinking. What's the likelihood that they're actually going to make this change? That is the question that most people ask when they sit down to talk with me about this. The honest answer, I don't know. Nobody does. The media certainly don't. And even the government, at the time that I post this video, they won't have made their final decisions. So there is no answer. But if you want my opinion, and it's just that, I'm going to be very clear in this video, it's just my opinion that I'm sharing now. Well, I don't think that they will change the rate. That 25% rate, would you change it to 10% or get rid of it completely? I don't think it will go. And why? Well, because it would be a nightmare to change for a number of reasons. Firstly, you would crush confidence in pensions. I've said people understand and love this thing, so it would certainly be massively unpopular and it would change how people feel about contributing to pensions in future. It damages confidence, so I just don't see that being in line with what any government would really want to do. Certainly they'd be challenged on that massively anyway, and let's face it, we've seen a few U-turns around, haven't we? So if we say, well, they don't want to do it for fundamental reasons, you've then got the more practical aspect of, if you change that rate, all of the pension providers would have to make changes. I mean, you'd have to re-educate people anyway so they understood it in the first place, but then to practically pay the money out, their systems need updating. They're going to have to make some practical changes. So can you do this overnight? No, it's just not practical. So if you do want to go after tax-free cash still, What's the easier target? Well, we've now got that individual lump sum allowance, the £268,275 that I mentioned earlier. So you could reduce that allowance, that limit, down to 200,000, 100,000. I mean, pick a round number at least. I'm sick of saying 275. So if they do this, well, you'd be limited to a smaller lump sum, and any excess you'd have to pay income tax over and above that. But think about the practicalities again. So if they did this overnight on the budget, comes into effect and the allowance has gone down. What about the person that's not quite 55 but would get there just after the budget? They've already retired and their intention, their planning, was to pay off their mortgage with the tax-free cash as soon as they're able to take it. If you fundamentally changed the amount that they could get, it was a much smaller allowance and they had to pay a huge tax lump sum that they weren't planning for, well, that could ruin their retirement plans. It's impractical, it's unfair, and again, I don't particularly see this being achievable overnight. What I think is more possible if they do go after this is that it's scheduled for a future change, and that the transitional protections that whenever these types of changes have been made are available. So if you had that entitlement now, if it was right for you, you could apply to keep the higher allowance. This has happened before, and I expect that if they did make a change here, it would happen again. It allows you to sit back with a little bit more comfort and say, well, if they do make these changes, I'll assess it after the budget and make changes there, rather than force yourself into a quick decision now out of fear. Look, I'd prefer that they didn't make changes to pensions at all because it just undermines confidence. But I understand why the speculation always builds up to the budget, and maybe it'll be another aspect of pensions, like the tax relief on contributions on the way in. Maybe they'll reform that. Who knows? I don't, but I want to make the point clear that nobody does, and all of this speculation doesn't help in your planning. I know the noise is loud, and we're human, but try to make a decision from a rational standpoint as part of your wider financial planning. Lots of people in the run-up to the last budget speculated on this. Some of them thought they'd be able to put their tax-free cash back after the budget as sort of a cancelable transaction. Well, at least we know that's not an option. HMRC clarified up on that. I think HMRC were pretty miffed themselves, to be honest, with the way it was handled, and maybe took that opportunity to say, look, we're not messing around with this. You can't take your tax-free cash and then put it back. So at least we've got clarity on that. But if you want clarity in your life, if you're looking for financial planning, peace of mind, my contact details are in the description. I wish you all the best with your planning. Please make decisions from a rational, educated standpoint and don't decide things based on the speculation. I wish you all the best. Thank you for watching, and I hope to see you for a future video.